Hello everyone, welcome back to Alts Club. Let's dive straight in and unpack the major developments shaking up the crypto world.
Today, we'll analyze some of the most pressing issues affecting Bitcoin and the broader crypto markets, the recent massive liquidations, regulatory developments in the United States, and ongoing concerns about insider trading and market manipulation. Whether you're a seasoned trader, an investor, or just curious about crypto, understanding these dynamics is key to navigating this volatile but fascinating space. Before we dive in, make sure to subscribe to our channel and hit the notification bell so you never miss an update on Bitcoin, crypto market trends, and regulatory news. We will break today's analysis into three major topics: Bitcoin's price pressure and liquidation events, understanding the recent 20-30% risk drop and $1.1 billion liquidations, regulatory developments in the U.S. crypto space, examining Michael Selig's nomination to the CFTC and its implications, insider trading and market manipulation risks in crypto, exploring the transparency paradox and the need for modernized enforcement. Topic 1.
Bitcoin's price pressure and liquidation events. The crypto market recently witnessed a major shakeup, with Bitcoin revisiting the bottom of its local range, dipping to around $107,000. This decline coincided with the latest 0.25% interest rate cut by the Federal Reserve, a move that traders had hoped would stimulate the markets, but instead triggered over $1 billion in long liquidations in just 24 hours. To understand the situation, we need to analyze several interrelated factors. Firstly, Bitcoin's price action is closely linked to macroeconomic trends and investor sentiment. Despite optimistic macro catalysts, such as potential trade agreements between the United States and China, the crypto market failed to react positively. Stocks, represented by indices like the S&P 500 and Nasdaq Composite, opened down on the same day, signaling a broader market downturn. Gold, conversely, climbed above $40,000 per ounce, highlighting a flight to safer assets. Market participants offered differing interpretations. Trader Cryptnuevo suggested that Bitcoin's recent retracement was part of its typical behavior around Fed meetings, noting that the CME Group's Bitcoin futures gap had been filled and that the market structure remained intact. Conversely, Trader Roman cautioned that Bitcoin's failure to follow stocks during upside movements could presage further declines, possibly reaching a 30% loss if stock markets continue to weaken. This event underscores the fragility of bullish positions in crypto during periods of macroeconomic uncertainty. Liquidations of this magnitude expose traders to extreme volatility, reminding investors that leverage, while amplifying gains, also significantly increases downside risk. Historically, October has been a strong month for Bitcoin, with average gains of around 20% since 2013. Yet 2025 marked a rare red October, highlighting how unpredictable market dynamics can disrupt historical trends. In addition, the correlation between Bitcoin and traditional markets is complex. While some see BTC as a hedge, recent data shows that it can behave similarly to risk assets, particularly in times of market stress. Investors need to consider liquidity, macroeconomic signals, and technical ranges when navigating such volatile periods.
Topic 2. Regulatory developments in the U.S. crypto space. Amid market volatility, regulatory developments are reshaping the landscape. The Trump administration has nominated Michael Selig, a pro-crypto lawyer with a background in both the CFTC and SEC, to head the Commodity Futures Trading Commission, CFTC. If confirmed, Selig's appointment could signal a more favorable regulatory environment for digital assets. Selig has a proven track record in crypto advocacy. As chief counsel to the SEC's Crypto Task Force, he analyzed major cases such as SEC v. Ripple, arguing that XRP should be treated as a fungible commodity, akin to gold or whiskey, rather than a security. This stance is crucial because it may allow the CFTC to take the primary role in overseeing cryptocurrencies like Bitcoin, emphasizing derivatives and anti-fraud measures rather than strict securities regulations. The U.S. legislative context adds complexity. Congress is deliberating the Responsible Financial Innovation Act, a bill that would reclassify many digital assets as commodities. This reclassification would align regulatory responsibility with Selig's philosophy, centralizing oversight at the CFTC. However, political delays, including government shutdowns and bipartisanship hurdles, have slowed progress, leaving agencies operating with skeleton crews. Cross-agency collaboration between the SEC and CFTC has improved under initiatives like the SEC's Project Crypto and the CFTC's Crypto Sprint. Acting CFTC Chair Caroline Palm highlighted the importance of collaboration to eliminate jurisdictional ambiguities and foster innovation. Yet the effectiveness of these measures depends on full government functionality. Without adequate staffing and a confirmed chairperson, major rulemaking efforts and approvals, including those for crypto ETFs, remain stalled. Selig's nomination represents hope for crypto enthusiasts and investors. By advocating for clear commodity treatment, he could provide the regulatory clarity that the digital asset market has long lacked, potentially boosting confidence among institutional and retail investors alike. However, all of these regulatory efforts are contingent on political alignment and government budget approval.
Topic 3. Insider trading and market manipulation risks in crypto. While regulatory developments are ongoing, the crypto market's transparency exposes another challenge: insider trading and market manipulation. The largest liquidation events in recent history, which wiped out $19 billion in long positions, may have been facilitated by preemptive knowledge of Trump's punitive tariffs on China. On-chain data indicated that a massive short position was executed just 30 minutes before the announcement, resulting in $160 million in profits for a single trader. This event highlights a broader issue. Despite blockchain transparency, the market remains vulnerable to human behavior and informational asymmetries. Token launch models often grant pre-launch allocations to venture capital firms, enabling profitable sell-offs at the expense of retail investors. In many ways, crypto mirrors traditional finance, where centuries-old laws have struggled to prevent manipulation. The 2008 global financial crisis exemplifies the failures of enforcement, where major actors escaped accountability despite overwhelming evidence. Existing laws like the U.S. Securities Exchange Act of 1934 and Rule 10b-5-1 are outdated for today's markets. Prosecutions, such as the 8-year case of Matthew Panawat, demonstrate how slow and limited enforcement can be. In the context of crypto, where billions can be transferred in seconds, these delays are untenable. Modernized regulations should expand the definition of insider information to include government briefings and policy channels, strengthen pre-disclosure and cooling-off periods for officials, accelerate enforcement timelines to match the speed of digital markets. Blockchain's transparency paradox offers a solution. By exposing on-chain activity, regulators can identify suspicious patterns, investigate manipulation, and enforce accountability more efficiently than in opaque traditional markets. Yet prosecuting crypto-specific incidents without broader legal reform risks treating symptoms rather than causes. True reform requires updating laws, closing loopholes, and enforcing consequences consistently. For investors and participants, these insights serve as a reminder. The crypto market is a double-edged sword. Its openness provides visibility, but human behavior and regulatory gaps create significant risks. Navigating this landscape requires strategic awareness, careful risk management, and staying informed on regulatory changes. Conclusion. In summary, today's analysis highlights 3 critical aspects shaping the crypto ecosystem. Market volatility. Bitcoin's sharp declines and $1.1 billion liquidations demonstrate the fragility of leveraged positions and the influence of macroeconomic events. Regulatory evolution. The nomination of Michael Selig to the CFTC and ongoing U.S. legislative efforts could provide the clarity and consistency needed for crypto adoption, but political uncertainty remains a challenge. Market integrity. Insider trading and manipulation remain significant risks, underscoring the importance of updated regulations, vigilant enforcement, and the market's own transparency tools. For crypto enthusiasts, these lessons are vital. Understanding macroeconomic, regulatory, and ethical dynamics is key to navigating the volatility and opportunities of digital assets. While the market remains unpredictable, informed participants can leverage insights, reduce risks, and identify long-term opportunities. If you found this analysis helpful, don't forget to subscribe to our channel, like the video, and turn on notifications for more in-depth crypto insights and market breakdowns. Your support helps us bring you the most accurate and timely information in the crypto world.